What's going on, guys, and welcome back to another video. So today I thought we'd do something a bit different and rank my Trading212 portfolio in terms of my best to worst stocks. Now on this list of 1 to 30, we'll use a few different factors. We'll look into my favorite companies in terms of interest, also the ones that are performing the best, and finally what I believe are the best stocks for the future. Just two things before we get into all of that. Firstly, it goes without saying that I'm not a financial advisor, so just because I rank a certain company number one doesn't mean you need to do so also. So it's all kind of got to do with your own personal opinion. So do your own due diligence before investing any of your hard-earned cash. And second of all, as always, if you're new around here, it'd be much appreciated if you consider subscribing to the channel. And with all that being said, let's dive right on into today's video. So at the moment we have about €7,700 invested, so we're about 7.7 of the way towards my overall goal of having €100,000 invested in the market. Now, as you've seen any of my prior videos, you would see on the left here that I always group my stocks into different sectors, and I have 30 stocks, all blue chip, and there's two main reasons for this. Firstly is got to do with diversification, so you really do need to have stocks within a lot of different sectors, if not all. In my opinion, if you're a long-term investor, like if you saw any of my prior videos here, you'd see that some of my sectors are up 30%, whereas others might be down 5 or 6%, so different sectors kind of react differently to different market conditions. And the second reason why I have 30 companies is because to take advantage of dollar cost averaging. For example, if I just held Chevron at the moment, that stock in my portfolio is up about 60%, so there'd never be a time really where it would go back into the red in my opinion, especially when it's up 60%. However, if you have 30 stocks, there's always a kind of chance that one of them, if not more, will be in the red. There's been a lot more than one over the last few weeks due to the current market conditions, but that just poses great opportunities to buy further to help improve your dollar cost average. So as I said, today we're going to rank my stocks from 1 to 30. I got the reason or the idea for this video because of if I was ever to rebalance or rejig my portfolio and reduce my overall amount of stocks, what stocks I'd cut off at any given time. So we'll start from the bottom, we'll go from 30 up to number 1, and I'll give a very, very brief reason why it's in that position because of 30 stocks, so it can only be fairly brief for each one. So if I had to get rid of 5 stocks from my portfolio, they would be as follows: Waste Management, Caterpillar, Nike, P&G, IBM and 3M. Now, you could say as well, if that's the case, why don't you get rid of the stocks? But I'm keeping them there for diversification at the moment. And again, for dollar cost averaging, the 2 points why I mentioned I have 30 stocks. Now, the reason I'd put the 5 of these stocks at the bottom of the pile, it's not because they're bad stocks by any means. In fact, they're all fairly relatively safe blue chip companies. However, again, I said at the start of this video that I'd rank these stocks kind of based off a few different factors, such as how they're performing. Now, all 5 of these stocks are actually doing relatively well in my portfolio. However, in terms of long-term potential, there's certainly more stocks up the list that I feel have a lot more potential going forward. For example, Caterpillar in 29th position is currently up 42.77%, so it might be crazy to think that I have that the second bottom of the pile. 4 of the 5 of these stocks are all in the red and fairly well as well. We also have the likes of 3M, which is up 10.9%, Waste Management, which is in bottom position, is up 6.77%, IBM is up 4.7%, etc. So again, it's not just based on the overall performance at the moment, it's solely based on what I believe has the most potential going forward. Stocks ranging from 20 to 25 range from the technology, healthcare and energy sectors. We can see again here, Pfizer in the healthcare is down 2.48%, AbbVie again 24.5% in the green. We then have Microsoft up 12.31%, and then 2 energy sector stocks. Again, you might be asking why are they down so low if they're doing so well. We have Chevron up 50% and ExxonMobil up 78.7%. So very briefly, the reason Pfizer and AbbVie are on this list, are in this position, is because I kind of added them in mainly based for dollar cost averaging and diversification. I do prefer Johnson & Johnson in the healthcare sector, but again, I wanted to diversify across a few different stocks within this sector, so that's why I chose the 2 of those. We then have Microsoft. That would probably be the 4th favorite of my 5 tech stocks, again behind IBM, which is down below. Again, there's nothing at all wrong with any of these stocks. In fact, Microsoft is a well-established blue chip company. However, going forward, I do feel that we look up the list later, my other tech stocks have a lot more potential to grow going forward. And then we have the likes of Chevron and ExxonMobil. Again, both doing very well at the moment. However, the reason they're down so low is because going forward in the next 5, 10, 15 years, in my opinion, and probably in a lot of people's opinions, it's down to clean energy stocks. So that these kind of old school Chevron and ExxonMobil's, the kind of old school energy style companies, in my opinion, will start to fade out over time. So that's kind of why they're down so low at the moment. In terms of 15 to 20, we have two financial stocks in the form of Goldman Sachs is up 65.6% and JP Morgan is up 56.15%. Now again, they're doing very well at the moment. However, I have 5 financial companies, so they all couldn't be higher in the list. So that's the reason why I had to pick both of these currently in between the 15 to 20 positions. We then have the likes of Realty Income, which is up 2.97%. Again, I really like Realty Income. One of the main benefits of this going forward is that it pays a monthly dividend, and it does kind of help diversify your portfolio if you haven't any other kind of real estate sector companies within your overall portfolio. However, going forward, I do feel that real estate might take a hit as more people will be beginning to work from home kind of full time as such, so that could have a knock-on effect within this sector. In 16th position, we'd have Johnson & Johnson, my favourite of my healthcare stocks, and the reason it's not kind of higher in the list is because I don't feel that there's a lot of potential. Again, there is, but there's not as much potential, should I say, as let's say the tech and other companies that I have above. It will always be one of those stable kind of healthcare kind of blue chip companies, so it is going to remain on my list. However, you wouldn't become rich from it as such, if that makes sense. So I do feel there's a lot more potential going forward within my other companies above. And then in 15th position, we have iShares Global Clean Energy ETF. It's currently down 16%. Now, a lot of people will be like, hang on, why is it up so high in your list if it's down so much? And that's mainly due to long-term kind of potential, in my opinion. As I mentioned earlier, Chevron and ExxonMobil, two old school energy stocks, are doing brilliant at the moment. They're both up about between 50 to 70%. However, long-term, again, you need to focus long-term if you have a long-term portfolio. So clean energy, in my opinion, is going to be big going forward, and iShares Global Clean Energy ETF is certainly a great way of getting into this. Now, I have made more in-depth videos on iShares Global Clean Energy. I'll link them in the description below. So that's one of the main reasons why I have so many companies is the dollar cost average. And this is a prime example here. It's down 16% at the moment. It was down about 25, but over the last few days, I've started to trickle in 10 to 20 euro here and there to help improve my average. And in the long term, if it keeps continuing to dip, I'll keep continuing to add more funds in, effectively give me a better overall average price. And in the long term, I'll get a better overall profit. So the next 3 companies on the list are all in the financial sector. They are Bank of America, Visa and MasterCard. Bank of America is up over 50% and the other 2 are up over 9 to 12.5% each. Now the reason they are not higher up in the list is because, just like some of the other stocks below that have been doing very well, is because that going forward, again, it's a safe bet to kind of have blue chip diversified companies such as the financial sector stocks and banking stocks. But they won't kind of make you a millionaire overnight either. Again, no normal stock will, and if someone does say that to you, then they're lying as such. But again, going forward, in terms of potential, I do feel that there's more stocks above that we'll mention now that I do feel going forward have a lot more potential to jump up higher in value. In 11th position, we have Facebook, which is up 4%. Now, a lot of people might have Facebook higher on their list. Again, I do like Facebook overall. It has been in a lot of controversy over the last few months or even years though, in terms of data privacy and protection. But people kind of don't realize, some people don't realize, should I say, is that Facebook isn't just Facebook as such. They have many different apps, mainly all got to do with communication, such as WhatsApp as well. So going forward, they do really have a stronghold in the communication services sector. But as I said, the controversy of this company does pose good chances dollar cost average when this does drop from time to time. But at the moment, I think it's a fair reflection of where Facebook is and have it 11th on the list. In number 10, we have an ETF in the form of the FTSE 100, which tracks the top 100 companies within the UK. It's currently up 13.5%. Now, the reason I have this in 10th position, it could have been lower on the list. However, I do feel that it's kind of validated in 10th because firstly, it helps offer further diversification outside of the US, so this is the UK market. So this does help pose more of a global diversification. And again, just like every other ETF that we'll mention later on as well, that it is brilliant to have ETFs such as these in your portfolio because it really does give you an overall market picture. In 8th and 9th position, we have Coca-Cola and PepsiCo. Coca-Cola is up 5.8% and PepsiCo is up 1.8% at the moment. Now the reason I have these higher in the list there mightn't be a lot of upward potential in terms of it won't go up 30-40% overnight. However, Coca-Cola and PepsiCo are both very diversified stocks in their respective sectors, and they are certainly blue chip, well-known companies. And again, there's the kind of stocks that you can sleep easy at night knowing they won't drop 30%, but they won't go up 30% either. But in any solid portfolio, I really do feel that Coca-Cola and PepsiCo should be in your list. In 7th position, we have Walt Disney. It's up nearly 50% at the moment. We got in at a fairly good price, especially when the theme parks were closed and also movies were being cancelled at the moment because of cinemas being closed, etc. So we got in at a very good price, hence why we're up about 50% at the moment. Now, the reason Walt Disney is so high on the list, there's a few different factors. Firstly, is because who doesn't have an interest in Walt Disney? Everyone likes Walt Disney films, especially as a kid. Second of all, we got it at a good price, hence it's performing very well at the moment. And other reasons as well is number 3, is that going forward, just like Coca-Cola, they have a lot of expansion to do in my opinion, and they'll always be around. They'll never, no matter what happens in terms of market corrections or crashes, companies such as Walt Disney and Coca-Cola will always be doing well. We then have McDonald's and Amazon that are both slightly in the red at the moment, and that's due to FX impact. It's actually nothing got to do with the share price as such. Now, the reason I have McDonald's and Amazon so high in the list is firstly with McDonald's, it's not just a fast food chain in my opinion, it's more of a real estate company as well. Like for example, anywhere you look these days, within any built up area, there's a McDonald's store, and also they have the premises and franchise going with that as well. So McDonald's has a lot more going on with it than a lot of people think in my opinion, and it's certainly a solid company. Like McDonald's is never going to fail in my opinion, it's always going to be open. If you ever pass a McDonald's store drive through, any time of the day, any week, any month of the year, it's always going to be jam-packed. So that's one of the main reasons why I have McDonald's on the list. Then Amazon above, again, FX impact is putting that company into the red at the moment in my position. However, Amazon is certainly one of the main companies going forward in terms of online shopping and such other things as Amazon Prime, etc. So definitely Amazon is one to watch going forward. Again, a lot of their potential has been priced into their share price already, but I do feel, just like the companies I got to mention above as well, that they have a lot more room to grow going forward. Now in 4th position, we have Alphabet Class A. It was a kind of tight squeeze between Alphabet and Amazon for 4th spot, and the only difference was how it's performing at the moment. As I said, Alphabet Class A is up about 44%, but I kind of find it hard to kind of put a kind of comparison between these two stocks, as I really do believe going forward these two are big strongholds. We then have in 3rd position Tesla. Now, a lot of people's favorites before, and a lot of people kind of despise them at the moment due to the current price. However, the main reasons why I have Tesla in 3rd position is firstly because they are down 18.8%. Again, that might seem strange to some people why I'm putting them so high if they're down. However, that poses a lot more potential going forward for the stock. Again, it helps people get in at a cheaper price, or even if you had the stock already, it gives you a better opportunity to cost average going forward. Now, obviously, it goes without saying, the reason I have Tesla so high as well is got to do with the future of transportation and other such sectors. So, electric vehicles obviously are going to be the way forward. So, Tesla has to be on anyone's long-term stock portfolio list. 2nd position, we have Apple. It's up about 10% at the moment. Now, in my opinion, Apple is certainly one of the best companies in the world because they have, firstly, their stock price. Second of all, they are diversified across numerous different sectors at the moment. They're kind of getting more into the Apple fitness side of things and even looking into electric vehicles as well. Again, everything I'm using at the moment, for example, this very computer is an iMac. My phone next to me is an iPhone as well. So I think going forward that Apple is going to take even more of a stronghold in people's lives, as weird as that sounds. But going forward, I think Apple has huge potential to keep going, just like Tesla as well. It is one of those companies that is going to continue to grow and expand as years go by. And another reason why I have it so high as well is because it will improve people's quality of life going forward. It makes things easier. It's creating new devices. It's innovative. It really ticks the vast majority of boxes in terms of what a stock wants or needs going forward as a long-term investor. And at number 1 might be a surprise to an awful lot of people, is the S&P 500 ETF that tracks the top 500 companies within the US. At time of recording, we're up about 14.7%. Now, a lot of people be asking, why do I have this at number 1? And the main reason for this is that it tracks the overall market. and it can be very hard in the long term to beat the overall market. Hence why you should kind of always have a position within the ETF, especially the S&P 500. Now, another reason that I have the FTSE 100 is for diversification outside of the US, but if you're solely focused on US stocks, you really do need to have a certain portion of your capital invested within the S&P 500. So that's pretty much it for today's video. I just wanted to give a synopsis of my 1 to 30 companies ranked based off what my personal preferences are, how it's performing, and its potential to increase going forward. If you found this video anyway helpful or interesting, it'd be much appreciated as always if you could smash that like button, and if you're new around here, it'd be great if you consider subscribing to the channel. If you have any questions, comments, queries, or suggestions, please don't hesitate to comment below, and I'll be sure to get back to you as quick as I can. And most importantly, I'd like to see your list in terms of what your favourite companies are in your own portfolio and your reasoning behind it. Thanks very much guys, enjoy your Monday, and I will see y'all in tomorrow's video.